Good day, ladies and gentlemen, and welcome to the Shearman Sterling Dodd-Frank post-election briefing. It is now my pleasure to turn today's call over to Mr. Donald Lamson. Please go ahead, sir.
Thank you, Andrea. Good morning. I'm Don Lamson, head of Shearman's Washington, D.C. Financial Institutions Practice. For those of you who don't know me, I've been at Shearman for a little over 2 years now, and prior to that, I served in the federal government for many years, ending my career by helping draft portions of the administration proposal on financial reform that turned into the Dodd-Frank Act. I'll begin by making some observations and remarks. As a reminder, members of the press will be listening to today's call, so let's begin. President Obama and his reelection does not really signal a dramatic change in the landscape for banking regulation that might have occurred had Governor Romney been the victor. Had Governor Romney won, inevitably questions would have arisen about the status of the Dodd-Frank Act and what changes might have resulted. Obviously, repeal was unlikely, even with a shift in Senate control, as no one predicted a shift to 60 Republican votes. Any legislative changes that would have occurred would have been at the margins and based on support from both parties. I think all you need to do is look at the House bills that were introduced or passed during the last Congress to gain an indication of the type of brick-by-brick approach that might have been pursued to cut back Dodd-Frank. That's not going to happen this time, though. So as the dialogue continues on the size of the president's mandate following his reelection, we're going to gain a better idea of how much change we might expect. Senate and House control remain unchanged, but the numbers at the margin are a little different. It's a 55-45 split in the Senate with 12 new senators. The House nets 7 for the Democratic side, but the Republicans retain a majority of 40, as I understand it at this point. It's still a little early to talk about the ultimate makeup of the banking and agriculture committees, but there will be changes, as with any new Congress. For example, with the election of Elizabeth Warren in Massachusetts to the Senate, questions will arise as to what seat or committee she will gain a seat on. Obviously, as one of the people at the creation of Title X and the CFPB, people will watch closely to see whether she will be active in financial issues. It's not just the Congress that changes, though. Even with a reelected administration, scorecards will change. There will be comings and goings. We can look at the tops of the financial regulatory agencies. It's been widely discussed that the heads of Treasury, the SEC, and the CFTC may in fact be changing. For example, at the CFTC, Chairman Gensler's seat in April of last year terminated. He's serving now on an interim basis. The question inevitably will arise, will he continue in that role, or will he be offered something else? We don't know at this point. We're going to have to look and see and wait. The OCC, Mr. Curry, his appointment seems more secure now with the reelection of the president, the FDIC as well. A number of people are looking to see what happens at the Federal Reserve and whether Chairman Bernanke will stay on when his term as chairman comes up. There's a trickle-down effect after a change in the head of an agency. As people come and people go, as staff determine to depart in reaction to the change, it's going to take a couple of months for things to settle down to see where everyone stands. During that time, it's a little optimistic to think that there will be substantive changes. So this may be a quiet period. Inevitably, the question arises, will the administration be receptive to change on the financial services front. In the last year or two, the administration's been very clear that it does not want to see any changes to the Dodd-Frank Act. In this administration, though, we'll see. Currently, of course, there are a number of pressing issues that may push further financial reform into the background. For example, the fiscal cliff and associated issues on tax reform. You can, though, identify a number of issues in the last Congress that show where some pressure points might be in terms of financial reform. For example, bills were introduced in the House to restrict speculation in commodities. They're frequently introduced, and you might, in fact, see more of that in future, depending on the degree to which prices in commodities either rise very quickly or slow very quickly, or lower very quickly in response to world events. End user requirements relating to margin and capital were issues in the last Congress. Swap pushout is something to consider. That's been an issue. Whether there should be expanded exceptions from registration of swap dealers, the application of Title VII to non-U.S. persons, inter-affiliate issues. These were the issues on which some agreement coalesced, and there may be some room in the Congress to consider changes. Those are, of course, issues where people have proposed easing current limits. On the other side, in terms of an appetite for further reform, that's far less promising as the House remains in Republican hands. One area for possible reform is in terms of shadow banking. That, though, is, I think, more to be looked at from a regulatory agency perspective. The FSOC, the Financial Stability Oversight Council, has indicated an interest in this area, but the Congress may react as well. Would the administration be more apt to seek enforcement for violations that it finds at this point? There's been some talk about that. We'll have to see. I think most of the action in the coming year is going to be in terms of the administrative agencies. Just as the Supreme Court reads the newspapers, so do the heads of the agencies, as the saying goes. Now that the election results are in, I think I think the agency heads will be able to calibrate their responses to the new makeup of the Congress. So what areas are we expecting some action in? I think at last, in terms of the SIFI designation process, I think the FSOC is going to proceed. I think they've been acting in that area already, but I think we may see some announcements on that. When, in terms of the effect of that, there's enhanced supervision for any SIFI that's been so designated. There are enhanced liquidity requirements and requirements to create risk committees. Those requirements, by their very nature, will have a tendency to reduce the economic activity of the SIFI, and thus people will be looking to see, will there be an effect on economic activity in a broader sense as a result. In terms of the Volcker rule, we've been waiting for a long time to see how the agencies might come out in reaction to their proposed rule. The election, I think, by keeping the current makeup in the agencies pretty much the same, some new heads, but there'll be Democratic appointees if there are replacements. I think we're going to see stronger Volcker measures rather than weaker ones. The issues, if there is a final rule that comes out to keep an eye on, of course, treatment of sovereign debt in terms of the proprietary trading restriction, the exception for trading that occurs solely outside the U.S. by non-U.S. Banking entities, the distinction between market making and trading, which has caused a lot of consternation in the financial services area. And on the fund side, whether how far the foreign exception for fund sponsorship can go. These are things we're going to be looking at. On the Title VII front, we've been waiting to see what happens with SEC rulemaking. The CFTC has been far more active than the SEC. We understand that one of the issues holding up the SEC may be the whole issue of a cost-benefit analysis. The courts have been quite clear in terms of what types of cost-benefit analyses need to occur before an agency can adopt a regulation. The CFTC has found this out in terms of their rulemaking on position limits. One might wonder whether this decision, in fact, has had a reinforcing effect on the SEC. So we're hoping to see what happens in that in the rulemaking on the Title VII front, as well as how the SEC is going to be and the CFTC are going to be dealing with registration issues, especially in terms of foreign entities. In terms, the bank regulatory agencies have an outstanding series of rulemakings on capital, implementing Basel III. Those requirements, as proposed, have the effect of increasing capital requirements for banks, limiting the types of securities that qualify as Tier 1 capital. At the same time, in the broader economy, as growth remains sluggish, there's pressure on financial institutions to maintain their lending. Commenters on the capital rule worry about the effects of increased requirements on real estate lending. In particular, it remains to be seen how regulators will be able to square the concepts of increasing capital on the one hand and maintaining lending levels on the other. In terms of types of new capital, there are indications that so-called COCOs, convertible bonds, may be gaining increased acceptance. Until now, there really hasn't been a lot of appetite for them. So as banks try to cope with the new requirements, we'll see whether they are how far afield they look in terms of trying to gain new types of capital. Bank regulators under the new administration will still be looking at living wills. We're going into the second and third stage on that. Foreign banks are beginning their first stages. One question that will arise as you get beyond the first stage, which is basically the inventory approach, what types of entities do these entities own and how are they structured? As you go into the second and third levels, the legal questions begin to become more obvious. What types of divestitures will regulators seek? What type of consolidation of complex structures will regulators seek? What types of legal issues arise as a result? Will there be tax issues that arise? How similarly are entities going to be treated? So we can look for that. Because the administration is not going to change, it's being renewed. I think you might anticipate tougher regulatory responses in this area. There have been very few indications that merger activity is going to increase anytime soon, but there have been rumblings on this front. People will be asking what type of changes would a continuing administration have on the merger front in terms of merger review in the Justice Department. What type of changes would there be? I don't think that there will be a softening of approach in terms of review of mergers, new capital requirements, and a view of some regulators to limit the size of large institutions, as well as just the broader economic environment in which we operate. I think will place a damper on merger activity. If anything, you might anticipate larger institutions in particular either maintaining or reducing their size to thrive or to try to thrive in the current environment. Then there's the issue of how a second term of this administration would react to issues on the international front and with the EU in particular. On the administrative agency side, I don't think things have been particularly warm. There have been a number of extraterritorial issues, and by that I mean the way in which Dodd-Frank implementing regulations have had an extraterritorial impact. This was first seen with respect to the treatment of swap data repositories and indemnification in particular. That is very much an in-the-weeds type of issue, but the intensity of the response outside the U.S. to that issue gives an indication that, in fact, foreign sovereigns are looking very closely at how the administration handles extraterritoriality. More broadly, the issue of extraterritoriality is most prominent with respect to how the Volcker rule is going to be implemented and how swap dealer registration is going to be handled. For example, it was reported that at a CFTC forum yesterday, there was an exchange of ideas on that was, shall we say, frank. One question will be if the U.S. maintains a very expansive reading of how its regulations may be interpreted. One can ask, how will foreign sovereigns react? Will there be forms of retaliation? Will there be balkanization in terms of the activity of financial service providers? The CFTC has given its view on, in terms of proposed guidance on the extraterritorial impact of Title VII. We're still waiting for the SEC position. The CFTC has expressed the issue in terms of substituted compliance. That is, pardon me, that is the degree to which the CFTC will accept a foreign sovereign's legal system and requirements as a substitute for the U.S. regime in terms of transactions that occur overseas. Their interpretation is a sort of a pick-and-choose approach as opposed to the broader idea of national treatment that most of us are more familiar with. We'll see in response to the comments how, in fact, the CFTC will proceed. Well, I want to thank everyone for listening on the matter, and if you have any further questions on this that you might like to ask me offline, please feel free to do so.
And with that, ladies and gentlemen, that does conclude today's call. We do thank you for your participation and ask that you have a wonderful day.